Welcome to Fitch Ratings Fixed Interests Podcast. My name is Justin Patrie. Much has changed for the global credit outlook since the beginning of the year, and as always, Fitch has conducted a mid-year review and update of its annual sector outlooks. Non-financial corporates are among our most diverse group of ratings, with issuers ranging from over 17 sectors, including some sectors with high levels of exposure to the policy volatility and deteriorating economic outlook that we've seen thus far this year. To speak to our views on global corporates, I'm pleased to have with us Carla Taylor, Fitch's head of research for the Americas region and one of the analytical leads on our mid-year sector outlook update project. Carla, just to start off, tell me, what are sector outlooks and why does Fitch review and update these twice yearly?
Sure. Fitch's sector outlooks are forward-looking assessments of whether we expect the core credit drivers of a sector to improve, deteriorate, or be neutral in a given year. Let me take a few minutes to break down exactly what that means and what makes Fitch's sector outlooks unique. Fitch is in the business of assigning and maintaining credit ratings. So our credit outlooks include our expectations regarding key sector themes, our views about how those themes will impact the operating environment for issuers of corporate debt, and what all of that is likely to translate into for credit metrics and rating trends throughout the year. We establish sector outlooks every December, and because we know the world is constantly changing, we reassess those sector outlooks every June in order to incorporate changes in our assumptions regarding the economic outlook, sector KPIs, and aggregate sector forecast, all of which can be found in Fitch's quarterly Global Corporate Sector Forecast Monitor that is available to subscribers of our research. Our ultimate goal is to make sure we are effectively communicating up-to-date views on the near-term trajectory of every sector.
Now, you co-led the mid-year sector outlook update project for the corporates group. What are the broad changes that we've seen in these outlooks since they were last set at the end of 2024?
Well, I'd like to start by giving you a brief overview of our annual outlook process because it is quite thorough. At the end of last year, the Global's Corporates team published a total of 64 outlooks, with over 90% being neutral and just over 5% seen as deteriorating. So our outlook mix started off relatively benign. Earlier this quarter, we launched a formal review of these outlooks to determine whether sectors are performing as expected and to propose changes deemed necessary. Members of Fitch's leadership team weighed all of the proposed changes or lack thereof against our economic outlook, thematic developments, and our analysts' updated sector forecast to ensure Fitch's views are well vetted before going public. The bottom line is our outlook for global corporates has deteriorated over the past 6 months. The operating environment has become more challenging for many sectors, and our aggregate revenue growth and margin forecasts are trending lower as uncertainty regarding tariffs continues to present downside risk to corporate earnings. During this year's mid-year review, 14 of our outlooks were revised to deteriorating, with the total mix shifting to nearly 30% deteriorating and just over 70% neutral.
Now, you mentioned tariffs. Was that the only key issue driving outlook changes? What were the other key drivers of the shift from end year to now? And if there are 3 or 4 main issues to watch for global corporates in the second half of the year, what would those be?
Well, obviously the trade war, as you mentioned, but Fitch sharply lowered expectations regarding economic growth. There's also the prospect that interest rates in the U.S. could remain higher for longer than we originally expected. And U.S. policy risk also remains a headwind. And so those were the main catalysts for our outlook revisions. So we are obviously monitoring economic growth, as everyone is. We're monitoring the trajectory for interest rates throughout the rest of the year, and we're monitoring U.S. policy changes. But developments related to the trade war and issuers' response to these developments is really the most important watch item. The ability for U.S. corporate issuers, let me just say this, the ability of U.S. corporate issuers to offset the incremental cost associated with higher tariffs with pricing and productivity initiatives is critical for maintaining profitability. We have been expecting CapEx and M&A. We've also been expecting CapEx and M&A to increase this year due to secular trends such as AI and a less stringent regulatory environment in the U.S. So capital allocation changes could also be a potential response.
You mentioned 30% of corporate sector outlooks are deteriorating and 70% are neutral. You know, and the corporates group is a very large, diverse group of sectors and regions and countries around the world. Is there any regional or sectoral variation worth highlighting?
For EMEA, all 13 of our regional specific sector outlooks for EMEA, and we had 9 regional specific sector outlooks for Latin America. All of those remain unchanged. And then of the 8 sector outlooks published by our APAC region, only one, and that's APAC technology, was revised to deteriorating due to the negative impact of tariffs on hardware demand and weaker consumer spending, and also economic growth cited as reasons for that revision. So the majority of our sector outlook revisions were for sectors that were global, including global automotive, that sector, the global oil and gas sector, and global chemicals. And then our overall outlook for North American corporates and global leverage finance were also revised to deteriorating. Many of the sector outlook revisions in North America, including U.S. retail, U.S. consumer products, and U.S. restaurants, are consumer facing, as we expect higher effective tariffs to stoke inflation, with consumers' ability or willingness to absorb price increases being in question. Companies had significant pricing power that enabled them to sustain margins during the post-pandemic inflationary period of 2022, 2023. But then the health of the consumer was supported by a very robust job market and COVID-related stimulus. However, a weakening employment backdrop and the absence of significant fiscal stimulus to support consumer spending could challenge issuers' ability to raise prices to offset higher tariff-related costs.
Hmm. Are there any surprises or some sector outlook changes or lack of changes that some people might not have expected?
Yeah, I can think of two, Justin. Well, let's see. Well, first of all, I'll just start by saying many of the sector outlook revisions that we had this year were in sectors that were previously identified as being most sensitive to higher U.S. tariffs due to the presence of global supply chains or trade exposure. And this was the case for instance, global automotive, that sector, and the APEC technology sector. Um, but the maintenance of our neutral outlook on airlines, global airlines, might be a surprise given recent softening in leisure demand for travel in the US and potential upward pressure on oil prices due to the recent geopolitical developments that we're witnessing. However, our airline outlook, as I mentioned, is global, and demand remains relatively solid in other regions, and that is viewed as a potential offset to the slowdown in the US. And oil prices are still expected to remain lower than they were a year ago. Another surprise might be the revision of our global pharmaceutical outlook to deteriorating, given prescription drug demand remains secularly strong. However, President Trump's executive order back in May presents risks to the sector. These risks include the potential for pharma specific tariffs that could increase manufacturing costs, reduce pricing power, and the need to increase CapEx spending if supply chain adjustments are needed.
Thank you. Very, very interesting. Now, sector outlooks are distinct from rating outlooks, and you gave a great definition of sector outlooks at the beginning of our conversation. But we actually haven't seen much movement in rating outlooks, the outlooks for issuer ratings, while we have seen significant movement in sector outlooks. for corporates. Why is that? Why that distinction between rating outlooks and sector outlooks?
Yeah. Well, rating outlooks are different from sector outlooks in that they indicate the expected direction of an individual issuer rating over a 1 to 2 year period, whereas sector outlooks are 1 year in duration and it reflects our views on the sector. Rating outlooks incorporate our assumptions regarding how issuers will perform given the sector outlook and the level of headroom in their ratings. So it's not uncommon for an issuer's rating outlook to be neutral or even positive when the sector outlook is deteriorating because of things like their competitive strength and their conservative financial policies. To give you an example, we lowered our sector outlook for U.S. retail to deteriorating from neutral in early April due to our expectations that higher tariffs would negatively impact consumer spending. But our rating outlook on Walmart, which is the leader in the industry, obviously, remains stable due to its dominant position and our belief that it should be able to navigate these challenges more effectively than others. So as of June, approximately 80%, as you mentioned, most of them we haven't seen a lot of movement in rating outlooks. As of June, approximately 80% we rate like 3,500 individual issuers globally. 80% of them have a stable rating outlook. 11% of our rating outlooks are negative, and only 8% are positive. So these percentages are roughly in line with the long-term average we've seen for our portfolio. And what that means is that we're really not anticipating at this moment a significant increase in the pace of downgrades during the second half of 2025. And this is because corporate balance sheets are generally healthy and headroom in ratings provide downside protection if cash flow declines due to what we perceive as a more challenging operating environment. So, in terms of leverage headroom, at the end of 2024, 80% of Fitch rated issuers ended the year with leverage below Fitch's negative sensitivity. And overall, for our global portfolio, we're expecting aggregate total debt to EBITDA to be relatively flat for the year at about 2.7 times.
Well, thank you very much, Carla, for that very insightful navigation of Fitch's corporate sector outlooks and our corporate portfolio's ratings outlooks. That was very, very informative. And as always, thank you very much to our listeners. If you would like to learn more about Fitch's credit ratings and analysis and to read the latest on our mid-year sector outlook updates, please visit our website at fitchratings.com.